Very good afternoon, friends. Hope you're all doing great. In the previous session, we had touched upon our computation of income tax. We had done the basic pro forma, we had done the basic layout, wherein we know basically what are the incomes that form part of your earned income, of your unearned income, thereafter reaching at your total income, from which you do your deductions, calculate your net income, reduce your personal allowance, arrive at your taxable income. Taxable income is now split into your various groups as per the analysis of income that you do, and then as per the tax slabs, the tax liability is evolved, is calculated, on which you can reduce it further by claiming credit of the tax that you have already deposited at, so thus calculating your total income tax liability payable or taking a refund from the HMRC. Now let's have a look at how the property and the investment incomes fit into our income tax computation. Now to start off with the property business profits. What do you understand by the term property business profits? Definitely profits that are coming in from your property business. So profits that you are accruing, that you are earning from running the business of property business. So now this business can be from one property, can be from other properties. These properties can be of furnished properties, can be of unfurnished properties. What does furnished property mean? Definitely properties which have the basic furniture, the basic sofa, washing machine, refrigerator being provided to you as part of the accommodation itself. Unfurnished, definitely just the piece of house, the vacant house is being provided to you. So let's have a look at the general principle first, and then slowly and gradually we'll migrate onto the basic principles of your property business profits. The general rule, right, starts when where an individual is subject to income tax on profits arising from the letting of what? Furnished property as well as unfurnished property. So that is where the profits basically arise from. Now this property can be of commercial nature or can be of a residential nature as well. The rules that we are going to study are obviously going to be the fact that the property needs to be situated in the United Kingdom for it to be applicable for a income tax computation. What next? What is the amount that is going to be accessible under your property income is going to be that you first start with the net profits. Let me just grab the pen again. From the net profit from the lettings of all the properties owned by the landlord for the accounting tax period, which ends the 5th of April every year. So 15, 16, you're going to look at all the incomes that have arrived to the landlord for all his said properties starting from 6th of April 2015 up till the 5th of April 2016. Remember, for your earned income and your earned income, unearned income, your income tax computation, what forms part of your earned income? Your rental incomes coming from a furnished holiday accommodation. Anything apart from that forms part of your unearned incomes. So apart from FHA forms part of your unearned income. So now how are you going to calculate these two? Are you able to offset one loss against the profit of the other? Definitely not. Supposingly earned income you have made a profit, your unearned income you've made a loss. You cannot offset this loss against the profit of the other. It is not allowed. Here you need to separately show a profit. Here you need to show a loss. This can only be offset against the future profits of the same category. So when your unearned income is going to have a future profit, that is where you can set off this loss against. Till then, no offsetting you can say this computation part would not be allowed. Let's have a look at how you're going to calculate the computation of your property business profits, the pro forma for it. You first start with the income in the form of rental income. So you start with your rental income, the rent accrued due. In that you add only the income element of a short lease premium received. Remember, only the income element is going to be added. You exclude the capital portion of the gross premium received. Now this premium you're going to add only for the short lease period. What do you mean by a short lease period? A short lease period basically means when the term of the premium, the term of the lease is less than equal to 50 years. That is what comprises of a short lease period. So income element of a short lease premium is what your computation is going to be added with. Obviously, you need to reduce what? You can reduce your accrued allowable expenses in order to arrive at the net profit. Now, this is going to be calculate a separate computation for each property is going to be calculated. So this is how you calculate your property business profits. What else? What is a lease premium to start off with? Definitely it is a one-off lease lump sum payment which is made when you actually start the lease. So it's made at the start of the lease. We are going to look at short lease premiums here, which basically means a tenure which is less than equal to 50 years. What do? We only add up the income element of the short lease premium. What is the income element? From the total gross lease premium, you reduce the capital portion. What is this capital portion? The gross premium less your capital element, which is equals to 2% of the gross lease premium multiplied by n minus 1. N is the number of years for which the premium, the gross lease has been approved for. So basically what do you take? You start off with your gross premium, you reduce your capital element, arrive at the income element of the gross lease premium. N is equal to the number of completed years of lease. Let's start this. Let's understand this with the help of a very, very basic example. Let's have a look at the example. Example number 1, short lease premium. Mr. B grants a 20-year lease on a commercial property to Mr. A on 25th of March 2016 at a premium of £10,000. So the entire gross premium is how much? £10,000. Remember what you need to include? Only the income element of the gross lease premium. Required, calculate the portion of the premium assessable as property business profit for Mr. B for 15-16. So what do you need to do? Only the income element is what you're going to pay tax upon. So you start off by calculating the income portion of the gross lease premium. How do you do that? You start with the gross premium first. Gross premium given to us is how much? £10,000 in the question. What do you reduce from it? You reduce the capital element. What is the capital element? Capital element is equals to what? It is equals to 2% of your gross lease premium multiply by n minus 1. So in this case, it's equal to what? It is equals to, let me just make it here itself, 2% of gross lease premium is £10,000 multiply by n is equals to how many years? It's a 20-year lease. So 20 minus 1, 19 years. This is going to be your capital element of the gross lease premium. 3,800. The resulting is your income element which is equals to 10,000 minus 3,800, which comes out to be 6,200 is your income element of the gross lease premium. So this is the amount that you're going to add up in your calculation of your business profits from the property business. So now let's move forward with our rules. What do we have up next? Right. Let's have a look at the whole list of allowable expenses that are going to be allowed for you to calculate your property business net profit. So now these allowable expenses as a general rule is going to be what? Obviously any expense which is revenue in nature. No capital expense is going to be allowed as an allowable expense. So any expense which is revenue in nature obviously needs to be incurred by the landlord himself. And any expense which is basically wholly and exclusively to the letting of the property before or during and between the leases. So basically any expense which is wholly and exclusively attributable to the said property that we're talking about is what you can claim as an allowable expense. Let's have a look at a few examples. Examples like cleaning and maintenance charges, repairs only if it was not cost before the property was acquired. Why? Because such repair would be added to the cost of the property itself. Why? Because it is going to be capitalized. Taxes in expenses like insurance, management, rent payable, water charges, council tax for your residential properties, your business rates if it is a commercial property that we are talking about, capital allowances on the cost of plant and machinery for property maintenance, impairment losses which is also known as bad debts, any loan and loan interest. Now all of these are very general in nature, which would obviously be you'll be able to wholly and exclusively acquire the said property. Now one very important thing for you to remember is the wear and tear allowance, which would not be specifically given to you in the question. It would not be told to you in the rates and allowances sheet as well. You need to know that if it is a furnished property that we're talking about, you always need to deduct a wear and tear allowance at the said applicable formula, for which is 10% of your gross rent less water rates and council tax. So please remember not to exclude this. Always you need to include this in calculating your property rental income, your net profits from your property business. Always deduct your wear and tear allowance, provided the property is a furnished property used for residential purposes. You need to reduce a wear and tear allowance. Also for your furnished holiday lettings, a capital allowance on furnished or white goods, which basically means electricals like refrigerator, microwave, would be reduced if it is within the property itself. Apart from these, the general rule is that what? It is revenue in nature, it is incurred by the landlord, it is wholly and exclusively for the said property itself. The others would be given to you, more or less you will be able to make out whether or not it is pertaining to the said property. What would never be given to you and you need to calculate on your own is your wear and tear allowance if the said property is a residential property and it is a furnished property. The formula for your wear and tear allowance is what? 10% of your gross rent less what? You reduce your water, that is your utility, less your council tax charges to arrive at the wear and tear allowance. Let's have a look at this, how we need to calculate it with the help of an example. Let me open up an example for you so that we get good hands-on practice of how to calculate this wear and tear allowance, how to calculate the net profit of a property business. Let's have a look at the question. Mr. Davis purchased a house on the 6th of July 2015. It was let on a furnished basis from 6th of September 2015. Basically, what has happened? This has now gone on rent for the 7 months in the said year, from the 6th of September up till the 5th of April 2016 is what we are going to look at. When the lease was granted for a period of 10 years, a lease premium of £5,000 was received from the tenant. Remember, only the income element of this gross lease premium is what you're going to add up in your property business profits. Expenses in the accounting period are as follows. Repairs of 4,000 incurred in August 2015. 2,200 of this amount relates to the repair of the roof damaged by a storm in May 2015. Now, what is this time frame? May 2015 is before the property was actually let out. If the expense pertains to a time frame which is before the time frame when the property was actually purchased, you're not going to include it in the wear and tear, in the repair part. So this 2,200 repairs you're going to ignore for claiming an expense out. What happens to the remaining? The other £1,800 relates to external and internal painting and decoration, which obviously would be an allowable expense. Council tax of 600 relating to year 1 July on year 1st of July 1516 to 30th of June 2016 was paid in July 2015 for the entire year. How many months are applicable to the current tax year? From September up till, you're going to take from what time frame? From the 1st of July 2015 up till April 2016 is your applicable tax year. So for the 9 months is what you're going to include in the tax computation for the current year. The remaining 3 months go the next year. And utility bills accrued to 270 definitely will be allowed. Letting agent fees of 500 again will be allowed. It is paid in September 2015. Calculate the property business profits assessable on Mr. Davis for 15-16. So let's have a look at property business profits for 15-16. How much does it come out to be? Rental income is how much? Rental income accrued. We are going to accrue from a time frame of from September to April, which basically means 7 months, sorry. £6,000 multiply by 7 months divide by 12 comes out to be how much? Comes out to be, in your computation, you're going to include 3,500 only. Now let's move forward. Also you're going to include what? The lease premium received. Only the income element of it. So let's do a working for it. How much is gross received? Gross lease premium is how much? Is £5,000. Out of which you do what? You reduce the capital element. Capital element is calculated how? 2% of your gross lease premiums multiply by n minus 1 is the amount of capital element that you're going to reduce, which comes out to be how much? Gross premium was, say, £5,000. You reduce what? You reduce your capital element, which is equals to 2% of gross lease premium, which is 5,000. Multiply by n is what? How many number of years it is for? 10 years. 10 is n minus 1. Comes out to be £900, resulting into an income element of 5,000 minus 900 comes out to be 4,100, resulting into a total gross. Now what do you reduce from it? You reduce your allowable expenses. So less allowable expenses. How much are your allowable expenses? Your allowable expenses are going to be, let's have a look at the various expenses that you've done. The first being repairs, only 1,800 out of which would be an allowable expense. Why? Because 2,200 has been incurred before this property was actually let out. What else is going to be allowable expense? You're going to allow a council tax. Council tax for the said period, which is 9 months. So you're going to take what? 600 is for the entire 12 months. Only the 9 months pertaining, which equals to 450 pounds. Also, you're going to take utility bills, which is going to be equal to how much? Which is equals to 270 pounds. Also include your letting agents fees, which is equals to how much? Your letting agents fees is equals to 500 will be allowed. Also, don't forget to include what? It's a residential property. It's been given on furnished basis. So don't forget to include your wear and tear allowance. I'm again and again reiterating, it will not be mentioned in the question. You need to be able to calculate this wear and tear allowance yourself, which is equals to what? 10% of gross rent less your water rates less your council tax. So in the said question, what do we have? This is equals to 10%. What is the gross rent? Gross rent is 7,600. Minus, what is the water rate? What is the utility bill? 270 minus your council tax of 450 comes out to be is equals to, I haven't put the multiply sign. Let me just put the multiplication sign here. Right, comes out to be 688. So 688. Total allowable expenses come out to be equal to how much? Equal to 1,800 plus 450 plus 270 plus 500 plus 688. So 3708 is what is going to be your allowable expense, resulting into a net profit. Net profit of how much? Net profit of 3,500 plus income element minus your allowances come out to be 3,892 is your net profit from the said property, which you're going to include in your income tax computations. Now, having done this, let's get back to our rules. There is an option for rent a room letting. Let me first explain you what this concept is all about. Rent a room letting basically means that in supposing you live in a 4-bedroom house, you've got a spare room in your principal private residence, which is your home. What do you do with this spare room? You can actually give it out to a tenant. So now when you give out one room in your principal private residence as a rent a room option, whatever rent you've earned out for it is basically either it is going to be an exempt income if it is below the threshold level of 4,250 pounds. If it is more than the threshold level of 4,250 pounds, the excess basically gets taxed. So basically it is a rent a room letting where in the principal private residence, which is the home of the principal private of the landlord. What happens basically? What is the rule? The rule states that if your gross income is less than 4,250 pounds, the entire income becomes exempt. However, if your gross income is more than 4,250, the excess amount gets taxable. Either basically what? Either you tax what? Either you take your net profit, which is equals to gross income, less your expenses, or what else you can do? You can take your gross income and reduce the basic threshold level of £4,250. This is going to happen when obviously rent a room selection has been made. So basically every person who has a spare room in his property and has given it away on rent has either of the two options to avail. Either on the said room you take your profit, that is your income, less expenses, pay tax on this profit, or when you've actually opted for a rent or room selection, what do? Out of your income, which is your rental income, you reduce the threshold level of 4250, and on the remaining profits you pay tax thereupon. So basically entirely the discretion of the taxpayer, of the landlord, as to whether or not he wants to take the rent a room option or not. Now practically, what do you think when it will be beneficial for you to actually opt for this rent a room selection? Definitely when resulting tax, the assessable amount is less, only then you want to opt for rent a room option. Now this option, obviously the window to opt for it is not going to be open forever. This option must be made by 31st of January within 2 years of the end of the tax year. So for 15-16 it stands for 31st of January 2018 is the last by which you must opt for rent a room selection, or not for 15-16. Supposingly for a married couple or civil partners, they have a joint property, and out of that property they have actually let out a room on rent. What happens to that income, which of the rental income that basically accrues to both of them? Definitely would be added 50% in both of their incomes, unless a joint declaration has been submitted to the HMRC. So for two persons entitled to rent a room, the income, the relief also comes 50%. So basically taxpayers can choose not to apply for rent a room. When would that happen? When definitely their assessable income becomes less, having not opted for rent a room selection. Let me explain this to you with the help of an example. Let's do example 3 and understand why renting a room would or would not be beneficial to the taxpayer. So what do we have here? Roger lets out a spare room in his principal private residence, which is obviously his home, to his lodger Peter. During 15-16, Peter paid a weekly rent of £120 and Roger incurred expenses of £5,100 on the said room. Roger made whether or not it would be rent a room selection for an earlier year. Explain whether or not it would be beneficial for Roger to continue with the rent or room selection, or should he withdraw from this selection this year. So what we're going to do, we're going to look at both the options. Let's have a look at what happens, what is the tax liability with rent a room selection. So basically you're continuing with what you had opted for in the previous year. What is your income? What is the gross rent received? Gross rent received is equal to 120 multiplied by 52 weeks, which comes out to be £6,240. Out of that, what do? You can claim your rent a room exemption. Exemption amount is what? Exemption amount is £4,250. The remaining becomes your assessable amount. Remaining amount is assessable, which is equals to 6,240 minus 4,250. £1,990 become accessible in the hands of Roger. Now let's have a look at the other option, which is without rent a room selection, which is what? The gross rent received is equals to what? Is the same 6240. What you can do is now you can claim the expenses. Expenses of how much you've incurred? The question says 5,100, resulting into an assessable income of 6240 minus 5,100, thus an assessable income of 1,100. 40 pounds become assessable income. So definitely what happens? What do you think? Would you rather pay tax on 1,990 pounds or would you rather pay tax on 1,140 pounds? Definitely you would want to pay less amount of tax. So let's keep our assessable income as 1,140 pounds. Thus, what you need to do? So, beneficial to withdraw rent a room election because assessable income is less upon withdrawal of the option. So basically your rent a room selection can be made by because your assessable incomes becomes less. So that is how you need to opt whether or not you would want to make rent a room selection or not. So let's get back to the rules now. Right, what do we have next? Let's have a look at the rules for a furnished holiday accommodation. Now, before I begin any further, what is a furnished holiday accommodation? Definitely, it is accommodation which you're giving away on rent. It is a furnished holiday accommodation which you're giving away as a rental property. Now, this furnished holiday accommodation, we all know, is a part of your earned incomes. It is a part of your earned incomes. The property needs to be situated either in the UK or the European economic area. For your examination points of view, it will always be located in the UK itself. It should be let out on a commercial basis and it must satisfy all the conditions of being a furnished holiday accommodation. So satisfy all the conditions. What are these conditions? Let's have a look at the conditions which you need to qualify in order to qualify as a furnished holiday accommodation. The first condition is that this said property must be available for being let out for at least 210 days in the said year. Also, apart from being available to be let out, it must actually be let out for at least 105 days in the year. So at least let out for 105 days in the year. And also your longer term lettings must be less than 155 days in a year is what you need to satisfy. All three conditions must be satisfied in order for the said property to become eligible as a furnished holiday accommodation. Now, what is this longer term lettings? It basically means being let out for consecutively greater than equal to 31 days is what you need to qualify to become a longer term letting. And also it does not count as a holiday letting in that consecutive more than 31 number of days. Now, what do you do basically? How do you calculate whether or not the said property is eligible to be classified as a furnished holiday accommodation? Remember the rules. It would not be provided to you in your rates and allowances sheet. You need to learn these rules to be able to check whether or not this said property classifies as a furnished holiday accommodation which is let out on a commercial basis, whether or not it is going to form part of your earned income or not. Separately, definitely a separate working needs to be assessed for each and every property which the landlord owns. Let's have a look at a very simple example to find out how we're going to practically apply these three rules, which needs all of them needs to be satisfied in order to classify as a furnished holiday accommodation. So definitely, let's quickly go through the rules again. It must be available to be let out for at least 210 days. It should actually be let out for at least 105 days in a year, and also longer term lettings should be less than consecutive, should be less than 155 days in a year. What classifies as a long-term letting? Being consecutively let out for greater than 31 days in a year, 31 consecutive days in a year. Let's have a look at an example and practically understand how to apply these rules. So let's have a look at example 4. Miss Jones lets out two furnished properties A and B during the year ended 5th of April 2016 as follows. So property A, we have the number of days. Property B, we've been told the number of days. The first information that we have is the lettings not exceeding 31 days. Each is equals to what? Let me just open the question here itself. So lettings not exceeding 31 days, so not longer term lettings. For the property A, it is equals to 200 days. Property B, it is equals to 150 days. Similarly, lettings exceeding 31 days each, which equals to, this is now equals to your longer term lettings, which is property A is 120 days, property B is 165 days. Also, this said property was unlet for 45 days, out of which 30 days the landlord had occupied the property himself, and property B was unlet for 50 days, out of which again 30 days the property was occupied by the landlord himself. One very important thing that you need to note down here is what does the rule states. Let's state the rules first, right? The rule says, rule number 1 states that the property must be available for let out greater than equal to 210 days in the year, greater than equal to 210 days in a year. Rule number 2 states that it should actually be let out for at least greater than equal to how many days? 105 days in a year. Also, rule 3 states that longer term lettings should not exceed, so should be less than 155 days in a year. So these are your rules. Let's find out if property A satisfies these 3 conditions or not. Now it is available for let out at least 121 days. When the property was actually let out 200 days, it was let out in the first place because it was available to be let out. So definitely it was available for 210 days. Also, when the 45 days it was not let out, it was unlet out. Was it available to be let out for the entire 45 days? No, 30 days the landlord had occupied the property himself. So definitely it was not available at that time. It was only available for the remaining 15 days. So this property was actually available to be let out for 215 days during the year. The rule says that it should be available for let out at least 210 days. So definitely rule 1, condition 1 has been met. Now let's move on to the next criteria. It is actually let out for greater than or equal to 105 days. This property A was actually let out for 120 days, which is greater than the required 105 days. So definitely condition condition 2 has been met as well. Now let's move on to condition number 3. Longer term lettings should be less than 155 days. Here the longer term lettings have been told to us as 120 days, which is less than the required 155 days. So definitely condition 3 has also been met. As per the rules, all 3 conditions have been met, so the property classifies as a furnished holiday accommodation. Income from therein is going to be added in your earned incomes. What about property B? Let's have a look at the same 3 rules for property B as well. So let me just erase this for you, so at least it becomes clear to us. Right. Rule number 1 says that it should be available for let out at least 210 days in the year. Property B was available to be let out for 150 days when it was actually let out for, plus when it was unlet for 50 days, out of which the property was occupied by the tenant himself for 30 days. So the remaining 20 days definitely it was available to be let out. This is less than the required 210 days. So condition 1 has not been met. Let's have a look at condition number 2. Actually let out for greater than or equal to 105 days. Property B goes out for 165 days. Condition 2 has been met. What about condition number 3? Longer term lettings should be less than 155 days. In this case, longer term lettings are equal to what? Sorry, this is 150 here. Longer term lettings are equal to 165. So definitely the condition C, condition 3 has not been met. So let's conclude by saying, since condition 1 and 3 have not been met, so property is not a furnished holiday accommodation. So very clearly we've been able to bifurcate that this property B is not a FHA. However, property A was able to classify, was able to fulfill all 3 conditions. So definitely yes, it was a FHA. So the 3 conditions, rule 1, rule 2, rule 3, all 3 needs to be met for the property to classify as a FHA. So make sure that you do not get confused. You need to learn these rules because they would not be provided to you in your rates and allowances sheet. Now let's move forward. Right. Let's have a look at the tax consequence of classifying a property as a furnished holiday accommodation. To start off with, let me just very briefly explain this to you. Let me just grab a quick pen. Let me change the color. How do I change the color? It's medium length. Where is the color of the pen? Right. So what do I do? Basically, if a property gets classified as a furnished holiday accommodation, it comes under your earned income. If the property gets classified as not a FHA, it forms part of your unearned income. Now both earned income as well as unearned income form part of your income tax computation. So what is the benefit of a particular property being classified as an earned income as opposed to being classified as an unearned income when eventually both the amounts get added up under your income tax computation? There is a few advantages, or there are a few tax consequences of a said property being classified as a FHA, which are as follows. Remember, in your previous class we had done about your relevant earnings. The relevant earnings for calculating the pension contribution includes your earned income. So definitely an advantage of your FHA that it will be classified as an earned income, because then your relevant earnings actually go up for your pension contribution. Also, the cost of all the fixtures and furnitures, which basically includes your furnishings, kitchen equipments, your sanitary ware, all of them attract more favorable plant and machinery capital allowances. We are going to do much in detail as a full-fledged chapter later on. Also, your FHA is a business asset for CGT purposes, attracting a higher rate of rollover relief, attracting holdover for gifts and entrepreneur relief, all of which again we will be doing as separate chapters later on. Let's just have a look at this question. Let's just have a look at another question, and let's have a look at another practice of your furnished holiday accommodations. So let's have a look at furnished holiday accommodation letting. Marks owns a house in the UK that is let on a commercial basis and satisfies. So definitely the marked examiner himself has told you that you need to, the said property is a furnished holiday letting. So you need not check whether or not it was a furnished holiday accommodation. The examiner has already told you. The relevant details for 15-16 are as follows. Rent due and received. So this much you've already received is 35,000. Allowable expenses are letting agents fees, cleaning and repair, council tax, water charges, insurance, everything is told to us. What do we need to do? We need to calculate. Capital also told to us is capital allowances on furniture and fittings for the house are £7,000 for 15-16. Mark and his family uses the house for 2 months each year. So all of these expenses are for 12 months. However, the said accommodation has only been let out as a FHA for the said 10 months. Why? Because for the remaining 2 months it is being used by Mark himself. So let's have a look at how we can calculate the business profits arising from the FHA for the given time frame. So let's start with the question. Let's calculate. Let's go back to home. Let's calculate your furnished holiday accommodation profit. Bear with me, my spellings have all gone haywire. For 15-16. First you include what? You include your, begin with the rental income. How much rental income is given to us? 35,000. What next? From your rental income you are going to reduce your allowable expenses. Now the first expense is the letting agent's fees allowed in full, which is how much? Letting agent fees is £5,000. Now what about your other expenses? Expenses like cleaning, and repairs. It was 2,500 for the entire 12 months. However, we need to only include expenses pertaining to 10 months for which they were actually considered a furnished holiday accommodation. What about the next being council tax? Again, council tax paid was 1,000. For the entire year, you need to only include for the 10 months given, which is 833. Up next is water charges. Water charges, which is equals to how much? Water charges of 1000 is given. Again, you're only going to include charges up till the 10 months period, resulting into 833 again. Sorry, it is 250 multiplied by 10 divided by 12, 208. Up next is insurance. Again, going to be how much? Again, you're going to include only for the said 10 months. So 150 multiplied by 10 divided by 12. So let's have a look at how much these comes to be. The 10-month period plus 208 plus 125. Sorry, a plus was made is equals to here plus, right, comes out to be 3250. Also, you need to include what? You need to include your capital allowances. Again, capital allowances for entire year are given. We will include only the 10 months figure. 10 divided by 12 comes out to be 5833, which is equals to 5833. So how much are your total expenses allowed? You can include, you can basically reduce a total allowable expenses of 14,018, resulting into a net profit. Net profit of how much? Net profit of rental income minus capital allowances comes out to be 20,917 pounds is what your rental income comes, net profits comes out to be. So very clearly we've seen that how calculation for furnished holiday accommodation kicks in under your furnished holiday and under your net profit is what you need to calculate upon. Now let's have a look at how losses and loss reliefs are going to be made under your furnished and under your furnished holiday accommodation, which forms a part of your earned income, and under your other income, which is your unearned income, which is income from property apart from furnished holiday accommodations. Now, like I told you, there is no set off allowed between your earned income and your unearned income. This set off against profit and losses is not allowed. So basically, what do you do if one of these accrue a loss? What do? You have to wait for the same category profits of the future year. So losses basically arrive when expenses are more than income. Losses will be relieved against the first available future business profits as follows. Loss against FHA would be only offset against future profits of the same FHA. Similarly, loss of all other lettings, which is unearned income, would be always set off against future profits from all lettings except your furnished holiday accommodation. So this is how you're going to calculate your losses and your profits. So basically, earned income, losses get set off against earned income, future profits. Similarly, unearned income, losses get set off against unearned income, future profits. So these are the rules that you need to follow. What next? Let's have a look at, now that we've done property income, now let's briefly look at how our investment incomes are basically accrued or incomes are basically added. A few of your investment incomes are exempt incomes. So like incomes that derive from NSIA and your incomes arriving from your NISA accounts, both in the forms of interest as well as dividend, are exempt income. So there is no tax liability that arrives from these incomes. Now from theory point of view, you need to know a little bit about your NISA income, your NISA account, which is a new individual savings account. In order for you to be able to open this account, you need to be at least of 18 years of age and you need to be a resident of the UK. So only then you can open up a NISA account, which basically means that income arriving from your NISA account in the form of interest and dividends are an exempt income up to the threshold limit of £15,240 is the threshold limit for 15-16. Now you can actually invest either in the form of stocks and bonds, or you can actually invest cash in your NISA account. So basically you can invest with two different account managers, cash element one and stocks and shares element the other, or with any one account manager having both cash as well as stocks. Now who is this principal account manager? Can either be a bank, can either be a building society, or can either be a mutual fund company. So it can either be of your mutual, can be an insurance company. So any of these can be a principal account manager. What else? There is absolutely no obligation to invest in every year and absolutely no obligation to invest in the same category or the same class. Supposingly 15-16 I have invested the entire £15,240 in my same, I have invested in my cash. However, next year I can also go ahead and purchase bonds. So now what does cash bring in? Cash obviously brings in interest, which is tax free. If you invest in stocks and bonds, definitely brings in dividends, which is again an exempt income. It is also, when you sell away these shares, it also becomes a exempt income from your chargeable gain. So which is basically a double benefit if you invest into your NISA. Now, why do you think the government is actually giving away exempt incomes? So that basically individuals get into the habit of saving. So basically the government is trying to encourage savings here so that exempt income in the form of interest and dividends be earned, and at least people of the UK who are residents of the UK more than 18 years of age get into the habit of savings. So very brief introduction, very brief theory knowledge is all that you need of your NISA account, which is a new individual savings account. That's it then. That brings us to an end of today's session. We've done both property, business profits, including your FHAs, and you've also done your investment incomes, which are exempt from income tax in the form of your new income savings account. Absolutely any query you have regarding today's session, please feel free to email it to me at shilpi@gmail.com. It was a very preliminary session, so I'm pretty sure you should not have any doubts. Make sure that you go through the examples which we've covered in this session today at home as well. Also do lots and lots of question practice at home. Go through the questions of your practice and revision kit. Go through the questions of your textbook as well. So that's it. Do lots and lots of practice so that we know absolutely where we stand at the end of this session. Please feel more than welcome to email any doubts that you have, not just in today's session but in any of the sessions till today. Any question that you have, any doubt that you have, please feel free to email it to me. That's it then. Thank you very much for today's session. Thank you.